as the day goes by. But on to earnings conversations. Then GIC Re reported its fourth quarter numbers, and we are now being joined by Mr. Ramaswamy Narayanan, who is the chairman and managing director at the company. Mr. Narayanan, good morning. Thank you so much for joining in. Your gross premiums for the quarter grew by 10%, and your net earned premiums were also up 9%. Now, what are you penciling in for FY26 when it comes to both these aspects, both the gross premium and the net earned premium as well?
So typically we would be looking for about 10% growth going forward, and simply because we are planning to grow both our domestic and international business. The international business for last year, actually we had degrown, and honestly in the last maybe 2-3 years we have been kind of consolidating our book. Our growth journey started last year. Last year we grew by about 10.72% year on year. So last year in October, we got our credit rating upgraded. For writing international business, you need to have a good international credit rating. So currently AM Best has rated us A- excellent, which allows us to really look at and get to see good quality international business. So 1st Jan, when the international business normally renews, we got to see a lot of good business from the market, and we wrote about 28% more. And the revenue for that will come in 26. Similarly, in 1st April 25, when the Indian market renewed, we grew there by about 8%. So overall, we expect to grow by about 10% in this year.
Right, good morning. This is Vinny joining in the conversation as well. What I want to also understand is in terms of your underwriting loss. There's a loss this time of around 224 crore rupees in Q4 versus a profit of 490 crores. What has led to that? One, is that a one-off that is coming in, or maybe possible that this could see an impact in Q1, FY26, Q2 as well?
Vinny, hi, good morning. Again, this is something that I've been telling analysts, the last couple of years, that unlike, I understand that, the financial markets and analysts tend to look at quarter-on-quarter figures. But then for our industry, whether it is insurance or reinsurance, honestly, I don't think it makes sense. Simply because, you could get a catastrophe in one quarter, which was not there the previous year, which would have happened in a different quarter. So suddenly some quarters look good, some do not look so good. So coming back to our performance, if I were to look at it from an annual perspective, we've actually done very well. Last year around the same time in April, when people had asked me what we were proposing to do, I said after 3 years of consolidation, we are growing now. So we would grow 10%, but actually we have done better. We've grown by about 10.72% for 24-25. We also said that we will be striving to remove or shave off 2% from our combined ratio every year. Now, this year we have actually done better. We have shaved off 3%. From 111, we have come down to 108. And our loss ratios have come down by 4%. Our profit before tax is at 8,650 crores, which is, a record for this company. In its 53 years, it has never touched this kind of figures. So we are very sanguine about what we are doing, the underwriting that we are doing, and how we are, essentially trying to ensure that the business that we are writing are profitable. Coming back to your question about Q4, what happened there? Simple. We write international business, so obviously we also write US. It's a big market. Now, if you see in the first week of Jan, the Los Angeles suffered the wildfire attacks, and obviously there were losses there. And we have got some losses, and the initial figures that we have got from our business partners, it's around $38 million. Currently, we haven't paid anything. This is all outstanding. But our actuaries also felt that, going forward, we should ensure that there are no shocks to the balance sheet from these losses. So we've actually provided for about $150 million for these losses. So that is one thing which has kind of caused a dip in the Q4. Second is again on provisioning of life business. Life, as you can make out, is a long-tailed business, goes over 20, 25, 30 years. And some of the business that we wrote about 10 years back, the loss ratios went up in the last couple of years. It could be due to COVID or something else. Based on that, we felt that the provisioning must improve, so we have improved it. So honestly, I think the loss ratios have been well under control. It's just that we have been more conservative and we have provided more. So honestly, I would say Q4 is a one-off. We will not see those losses in Q1 of this year.
Sure.
Now, Mr. Narayanan, since you mentioned the combined ratio, you brought it down from 111 to 108. Do you go below 105 in FY26?
Well, we will definitely try to do that. But last year, I had made a similar advisory, I would say, when somebody asked what is the glide path, how or when would you reach 100%? I had said it's not a 1 year thing. We will need to do it over a period of years. And we had typically said 2% each year for the first 3 years, and then about 1% for the rest of the next 4 years. I still stick with that. I would say this year also we will be looking to cut down by 2% for the next couple of years, and then come closer to 100%.
How big is the US market for you, Mr. Narayanan? You just mentioned that there were losses that you saw in the fourth quarter. How big is your international business? If you could give us a mix as well. And within that, the US exposure as well.
So currently, if you see my international domestic mix is 25-75. 25 is international, 75 is domestic. That's simply because, in the last 2-3 years when my credit rating was not up there, we've not been able to write international book as much as we want to. Like typically any reinsurer, we would want to spread our bets, not have too much in one country. So obviously our desire is to have international to domestic at 50-50 at some point of time. It will take some time simply because, some of the international markets, economies are not doing well. So I don't expect to grow too much there. Whereas the Indian economy is actually doing so well that you see a lot of opportunities to grow. Having said that, there are a few markets that we will try. Obviously, US and Japan are two markets that we are looking to. Japan simply because they value long-term relationships. They're also very security conscious. So we used to write a lot of business there. We paid a lot of their losses. And when due to the credit rating going down, when we had to step back, we knew that the relationship is still there. We've already started talking to them. So that is a market we will write. It will still not reach the levels that we were before the downgrade, but we will slowly increase that. Similarly, US is one market. It's a big market. So obviously we will look to write business there. It's a difficult market to write simply because compliances are difficult. What we do is we write business in head office from the US. We also use our Lloyd syndicate to write business there. Because when I write from the head office, I need to provide collaterals, which becomes difficult for us.
Okay. Sir, a quick one. I just wanted to know in terms of your fire as well as the motor side of your insurance, which accounts for almost 54% of the gross written premium. The performance there has improved. What is the expectation for FY26? And in terms of pricing, some analysts are highlighting better pricing. Is that something we're watching out for here?
Yes, definitely. So again, property, of course, we write both in the international market and here. And we are seeing pricing improving in both places. In India, honestly, we have been pushing the insurance companies to ensure that the direct market pricing that they do is definitely better, because otherwise this market becomes unviable. So that is something that we have been doing for the market, trying to tell companies how they should price, how they should manage their exposures, overall how they should ensure that the property portfolio remains profitable. So that we will continue to do, and we are very confident about the property portfolio. On the motor side, we write it only majorly in India. Very rarely do we write motor internationally because compliances can be difficult. It's a long tail class. So obviously we need to end up putting more capital there, which we don't want to do. So to come back to your point, yes, we expect property and motor to do better. It will of course depend on what catastrophes India face, because typically any floods happen, the first casualty is motor.
All right, Mr. Narayanan, thank you so much for sparing time and joining us on this insightful conversation. Wish you good luck for the rest of the year as well, the management of GIC Re.